Hello, everyone, and a very warm welcome to today's major markets update for Friday, June the 23rd, 2023. A picture of a bull. I'm going to show you the raging bull case because a lot of bears have turned bulls. And while I don't think it is a bull market, that is our alternative count. Please remember that. And when the bears turn bullish, we know that it is time to start looking lower, because when everybody is throwing in the towel and everybody's bought, only selling is left. But we always have to remain objective and cognizant of the possibility, even though I find it a low probability. There will be no summary slide because this is a little bit more of a broader overview. So I'm going to start here with work done by ElliottWaveTrader.net, Avi Gilbert. Last week or the week before, he posted his bullish count that we are potentially, it's still in this wave 5. But the problem I have is clearly we've overlapped with wave 1. So we are potentially in some sort of expanding ending diagonal. It could work. I don't like it. It's, you know, at some point you say, you know, we have wave 4 and wave 1 overlap. Are we really then going to bet on this wave 5? So yes, it is possible, but is it likely? I think when we start to see overlap before one, it's better to just throw that out of the window and say this is alternative count. Not saying he's wrong, he posted it just to show you that other people have been posting that we have a bullish potential. And that's how bullish things got. It got extremely bullish last week. So here is our beloved friend Pretzel. He posted this a couple of days ago, and he said this long-awaited bullish wave count with some WXY into last October's low, and now we're going to bull our way all the way to 5,000 plus. Is it possible? Yes. Do I have any confirmation? No. So far, we're still tracking our bearish count quite well, which might, in the intermediate term, the next couple of weeks, 2 months, not be done just yet to the upside. But so far, I have no indication that this is absolutely bull. And somehow, I don't know even how in the bigger picture this would look like because of this overlap we have. And I'll show you that one using the NASDAQ 100 as well. Another guy I follow is Headline Charts. Has a lot of great tools. Some of them I copied, for example, the PMO one. It's very technical. I like it. No Elliott Wave whatsoever. So that allows me to look at the market from a non-Elliott Wave perspective. And he always kind of concludes he's a bear. And now he's turned very bullish. This is from June 17, post update once every week. Again, nothing against the person. Great analysis, Headline Charts, blogspot.com. Great stuff, but he also turned bullish. Everything was bullish. Top of the range, looking good. No weakness. Everything looks great. He turned completely bullish. Breakout. Very bullish move, etc. Okay, so the person who always says at the end of his update that he's bearish, inclined to be bearish, is now also very bullish. I know it's anecdotal, but just to show you that some of the people I follow now finally posted their bullish alternatives, and what are we going to get? I thought it was just fun, and that's why I'm still not too bullish on the market. So the alternative is, oh, that one is wrongly labeled. I have to move this one there. So is that we have indeed a 1, 2, 1, 2, 3, 4, 3, 4, 5 type of wave. That would only be a larger 3, larger 4, larger 5. We're going to go to new all-time highs. The problem I have here, this rally is I cannot construe it into 5 waves. I cannot even make it into a leading diagonal. I cannot even make it into a maybe an expanding leading diagonal. It would be so ugly. But all right, worse things have happened. So 1, 2, 1, 2, possibly. Okay, possibly. But again, this wave 1 here is very construed. If that is the case, very construed. Now, if we zoom out, again, we have our wave 1 high here then in August 2020. 2, and then 3, and this should then be 4. Massive overlap. I don't know how to count this correctly. Okay, massive overlap. in fact, I think it counts better this way. 1, 2, 1, 2, 3, 4, 1, 2, 3, 4, 3, 4, 5. Counts picture perfect. In my humble opinion, this counts better than this, doesn't it? It counts way better. This looks very natural. A subdividing wave 3, as you can see, with a subdividing wave 5 of 3. Very nice. 1, 2, 3, 4. No overlap here with 4 and 1. It came with a couple of dollars, but no overlap is no overlap. Nicely subdividing. Looks really nice. And this is also 1, 2, 3, 4, 5. I like this one much better. And this is then primary 3 or super cycle 3 or cycle 3. And we're now in a primary 4 or super cycle 4, whatever it is, massive bear market. Okay, so far so good. And remember, bigger picture-wise, these are pretty much the metrics and parameters I posted now over a year ago, and nothing has changed. We're right in the target zone. Yes, we can go to 4,555. Yes, we can go to, as you can see here, to even 4,700 almost. That would be an 88.6% retrace. It's not uncommon. It wouldn't surprise me, given that we have just completed then a massive bull. So the initial residual buying is still there, and then the B wave might go a lot higher than 50% or 62%. Okay, retrace of the A wave. Absolutely possible. Absolutely possible. And remember, so we have A, B, and C, and that would then, of course, match with A, B, and C, what the guys at Elliott Wave Trader are seeing. And as you can see here, somewhere around 2,800 should be then our bottom. Now, I haven't changed a thing. Look what I have, 2,800. I haven't changed a thing. So why change the winning team? If the market is done, this is what we painted in so far. Is doing. Looks pretty good with a complex B, A, B, C. Okay, so this is probably irregular flat wave B, something like that. Whatever it is, even B could be topped here and bottomed there, whatever it is, still looks good. I see no reason to change with it. We can even make a new all-time high. Okay, the B wave. Why? Because then this wave A will become a flat. I've shared with you Tesla before, and Tesla had a large flat primary 4 wave, in my humble opinion, where the A wave was a flat. The A wave of the flat was a flat itself. Why? Because the A wave in a flat is 3 waves. So it's either a zigzag, a triangle, or a flat. So it chose to be a flat. It doesn't have to be a zigzag, not at all. So it's very possible that then the B wave of the A wave can become irregular. So much residual buying pressure is left over after 100 years of bull that it should not surprise us if that's the case. We start off with our initial assessment that we expect a zigzag down and a zigzag back up. That is the simplest, all right? Dumb as we are, that is the simplest we use. That's what we anticipate. Why would we anticipate the most complex one? I don't know. That's not how our brain works, does it? So we anticipate a simple zigzag lower for A, a zigzag higher for B, and a zigzag lower for C. Simple. And then we monitor it accordingly. And then all the scribbles and daily and minute variations will come into play. So if we knew this already a year ago, we're doing pretty darn good, aren't we? So now it's time to get cautious because we're in this upside. Can it go higher? Yes, then we'll just take the next trade. But I've already warned last week to be on your toes, and I think this week hasn't surprised. So I mean, short the shit out of the market, so to say, pardon my French, throw everything in the kitchen sink through the window. Not at all, but take appropriate risk management action. That's what your job is. Your job is to secure your financial well-being. That's not my job. My job is to interpret the markets, and so far I see nothing that has changed my tune. Again, we can even go make a new all-time high. Again, I still think we have a matching pattern. Remember, all the fourth waves are flat. I still think we have a matching pattern with what we saw in the 70s. This one is to update for once. Slow crap. All right. So we go all the way back to the 70s. Okay. For those that have been with me for a long time. See if we can get some update here going. They're nice. Thank you very much. Here are the 70s. Let's get some data going. There we go. A, B, C. See how complex this was? Incredibly complex. This is a similar type of pattern that I think we're going to see right now. Okay. So are we here? Is this A and this is B? And is this coming? Or are we here, right? That's the difference. I think we're here. Look at how long this took, okay? From 1968 to 1969. See this pattern? It looks quite similar, doesn't it? This pattern, if we zoom in, looks quite similar to what we have now. And then we should see quite a decline. We'll go back to that in a moment using the oil Dow Jones relationship. So here we bottomed somewhere in July 69, and we topped out into November 69. So that's a year and a quarter of a counter trend rally. We bottomed in October last year. So if we top out in October this year, it's a year. So it doesn't surprise me. It looks quite similar to what we're seeing right now. And then we get an irregular B wave and then a 50% correction for the fourth wave. Okay. And so, no, that one, sorry. So then we go back to where we came from. Okay, we'll go all the way back here to where we came from. Does that look too different? Not at all. So we should then be A, B, and C. Remember, that was a primary fourth wave. This should be a super cycle. So much longer, deeper, bigger, all that stuff. All right. So we've covered that. So it doesn't look so great for the 4 and the 5. Quite odd to see wave 4 and wave 1 overlap. I don't want to count on it. I don't want to bet on it. So I still count this then as completed. Green 3, now in green 4, green 5 to come, red 4, red 5 to come. So we can still do 4, 5, 4, 5. Alternatively, this is all of 4, and always left is another 5. And very alternative, of course, that all of wave B has already topped. That I will show you. That's the very alternative. But I would like to see some more pronounced negative divergences, though it's not necessary. We didn't see any negative divergence here in February, nothing in August last year, nothing in July, all that stuff. None of the tops have been really well telegraphed, meaning with negative divergence. Most of the time, we just get maximum readings and we fall off a cliff. Maximum readings kind of fall off a cliff in this case, but correct. Okay, maximum reading somewhere here. We've got some divergence lower. Look at this here, the slightest of divergence, but the risk here versus where we're there is insane. So 3, 4, 3, 4, 5 versus 4, 5, and that's it. I'm fine with it. Moving on then to the short term, this is the S&P 500. Looks like today's drop was orange wave 1. Now, we didn't even get to the lower end of the ideal C of B target zone yesterday at the close. That was 43.88, a 38.2% retrace. We did do 3 waves back up, A, B, and then this is wave C. And the futures market went a little bit higher. Okay, it went to about 43.85. So the futures market in after hours got very close to 43.88. And I think the drop looks like a 1, A, B, C for 2, and then 3, 4, and 5 on its way. 3 to about 4,300, 4 back to about 4,330, 5 to about 4,290, 4,270, somewhere around there. And that is then C/3 for potential 4, potential 4. Now, if we're going to get a 4 and a 5, okay, if we're going to get that, remember, from the daily update, so I'm so far not saying anything new. If we're going to get that, a question mark 4 and a question mark 5, then we have 5 larger waves lower, and I think that we have completed our counter trend rally already. Okay, then we have completed this larger B wave. If we only see 3 waves lower, then I'll be on board with this 4 and this 5. Okay, and then the B wave will extend a little bit further in time and in price. But any surprises? No, we had 45.55 as the target's upper end of the target. So even 46.90, again, it doesn't have to necessarily be a 62% retrace. That's what we start off with. And we surpassed it a little bit, so we can still surpass it a little bit. Nothing out of the ordinary. And then we go to about 4,500, 4,600 for this B wave. Again, it would match with this continuous residual buying pressure after about a 100-year bull market. Would surprise me if that's the case. Remember, we crashed in 2020 and we ripped it right back up to the all-time highs. So there's still this residual bullishness left. It takes a long time to burn that off. 2022 was just one down year. 2020 had a quite severe down, 15, 16, 2011, 18, 19. So there have been plenty of downs over the last decade, even 2008, of course, early 2000s, and we're still back to new all-time highs. So ingrained in us traders that we will continue this bull market relentlessly, that this residual buying, I call it, might cause a B wave higher than we initially anticipated, with an ideal target 4,300, 4,400. It's just ideal, it's anticipation. You monitor it and then you adjust accordingly. When we were here, it was impossible to know that we would get this pattern. Okay, impossible to know. If this is what you think I can forecast, I'm sorry, you're delusional. All I can forecast then is that we should go to 4,300, 4,400. Now we've gotten there, time to be cautious. Dow Jones can still do this 1, 2, 3, 4, 5, A, B, C. Remember, can still do it. If the alternative is that we topped already for wave C. Also this one, right? We haven't broken to new uptrend highs. The Dow Jones is lagging. Now this is the preferred one, 1, 2, 3, 4, 5 for a C wave, also based on seasonality, as well as on the oil Dow Jones relationship, which has a top due in August. So then we have something more of a pronounced 3, 4, and 5 to go in the summer months. Seasonality as well. I'll show you July and August are technically and often bullish. Alternatively, we have topped. Okay, that's the alternative. But I have no confirmation for that. We'll have to break at the minimum below the May lows. That's that one. I think it's the same chart. So IWM can still try for some sort of ending diagonal wave 5, but this one looks weak. I don't want to cover it too much. It's weak and bleak. This one topped in February already, and since then it's been downhill from here. This is a more economically sensitive indicator, okay? Because these are the smaller companies, small cap. Apple can do whatever it wants. It can buy all of Greece and Turkey combined, I believe it is now, if not more. Well, maybe the whole Mediterranean, and still have cash left. So whatever happens to the economy, Apple, those are the mega cap tech stocks. So they're in a whole different world. Small caps don't look good. So how we're doing on market breadth. So that's all I want to say for now. With the shorter term, of course, the notion that we, let's see, where can I find it? That we are potentially shutting up 3, 4, and 5. It's messy. So remember, it still looks corrective. And if we start going lower tomorrow of a Monday, we gap down, then I think the 3, 4, and 5, which would match with, again, with seasonality, which has a low into the end of the month, right? A little bit of up and down here, somewhere around June 21, 22, etc. But so that's what we've had, continued lower. Market breadth is still not confirming a new bull market. Bull markets, we need to get above 70 on the bullish percent index for the NASDAQ. As you can see here, above 70, above 70. We haven't gone above 70 since 2020. So also that one tells me this is not a new bull. It doesn't give me a warm, fuzzy feeling. It's still just a counter trend rally by the Magnificent Seven. Nobody else is pushing the market higher. How are we doing on the S&P 500? Because, of course, that's a lot more companies and it's more yada, yada. Hasn't been above 70 in a long time, not since 2022. Lots of negative divergence, also pushing higher with now only 60% of the stocks on a buy signal. So it's not good. It's pathetic. We need to see it above 70, preferably above 82.5. Those are the kickoff waves. Haven't seen the kickoff wave. I showed you the relationship where we have the ratio between the 200 and the 50 percentage, meaning how many stocks are above the 50-day and 200-day, and that ratio is neither confirming a bull market. How we're doing on the new lows? Let's see, we've got a little bit more of an update. It's still okay on the NYSE. It's below 50, but it's rising. And of course, the NASDAQ remains in danger territory. How we're doing on the AD line? Is the AD line bullish? Bull markets, we have a rising AD line, right? New highs in the AD as well, right? This is a bull. As you can see here, this is price. This is the AD line. At some point, you get some negative divergence. You get a larger top. Is this one bullish or is this one, nah? You'll be the judge of it, but this doesn't give me a warm, fuzzy feeling. Some people will point out the AD line for the S&P 500, but the real cherry on the pie. The real one is the AD line for the NYSE. Ask Tom McClellan. This is the one to focus on. And this one is making lower highs. Not good. Can it change? Sure. Can it change by Monday? Sure. For now, this is the data we have. Doesn't give me a warm, fuzzy feeling either. This one is highly diverging. All right. Highly diverging. This is what we want to see. This is what we have. How are we doing with the McClellan oscillator? Well, it's finally negative. We got a higher high, as you can see here, in price, with a lower high in the McClellan oscillator. Less stocks were participating. The McClellan oscillator measures the number of stocks declining, advancing, and that are unchanged. And we got a good little kick here, but of course it's much less than we had here. And now we're negative. So the summation index is following this path pretty well, where I thought we would get lower highs on the summation index, less strength. Okay, if you get above 70 on the strength indicator, it's time to get cautious, get long in the tooth. That's something else. But now we have a higher high price, but the summation index as yesterday's McClellan oscillator to that of today, yesterday's was added to the day before yesterday, etc. Doesn't look good. This is double negative divergence right now. Doesn't look great. Can always change, but for now, this is not a warm, fuzzy feeling looking chart. You can always bust through it, but for now, this is also where I would say this chart also has to become a little bit more cautious and more risk adverse. Okay. How are we doing on sentiment? Well, we bottomed at a quite low put-call ratio, 0.46, I believe it was, right at the high. Way too many people bullish. So we're still neutral. And after having been extremely greedy, historically, this has not been this greedy here in 2021, 22. We're now back to a little bit more normal levels, and we had extreme greed. Okay, so this is still suggesting that we need some more negative sentiment. Sentiment is still not good enough in the sense of still too bullish. This is the VIX divided by the VXV, all right? So it is 60 days out versus 3 months out or something like that. And as you can see, we just bottomed here. Normally, when we bottom, we're close to peaks. As you can see, very close to peaks. So this one has plenty of room. The VIX has plenty of room to rise, and that means the index has plenty of room to decline. Put-call ratio as a 10-day moving average, as you can see, also top. This is very close to a top. This is much closer to a top than it is to a bottom. We want to see it bottom out. So this one also has plenty of room for the market to drop. And if then our short-term Elliott wave count is correct, we get the 3, 4, and 5, okay, to go. So that should start to scare some people. Hopefully. Why? Because most people are still highly exposed to the stock market. The NAM, this is active investment managers, are still almost overexposed to market. They're above the long-term average, which should be about 72% exposed. We're at 80%. Okay, so this also suggests we're closer to the top than to the bottom. How are mom and pop doing? Still 43%. Now, this is data up till Wednesday, 12 p.m. Still 43%, still extremely bullish. So it seems like there's not much room to the upside left from this indicator perspective. Too many people bullish? Seems like it. We're definitely more than the standard deviation away from the average. That often is a warning sign. How we're doing CNN fear greed index? It's still a greed. Yesterday was extreme greed. So even yesterday and today has done nothing to this one, right? Better buy opportunities are presented when we're fear to extreme fear. Here we're still extreme greed. So also this one has plenty of room to go lower, and therewith also the indexes to go lower. Before we are presented with another good lower risk buying opportunity. I showed you the seasonality chart. It had a top here somewhere around mid-June. That's what we got, right? And then a drop here into yesterday, and then a little bit of a rally the day before that, etc. So looks good. And then we should see bullishness into August, September, which fits with the wave count I shared, where we should see a 3-4 rally to go. Now, this is the oil Dow Jones relationship. It's worked over 120 years, not all the time, but as you know, 60% of the time, everything works. Okay. Should be here in June, so we might actually get a similar candle for the Dow Jones, something like this. An end of month sell-off, and then July and August are left. Okay, well, that would fit, of course, with this 4 and 5. Okay, that would be the same, of course, for the Dow Jones 3, 4, and 5 going into August to complete this larger C wave. It would fit. Let's see if I can find the S&P 500 here with a 4 and a 5 to go. Okay, so we drop into end of June, and then July and August are still bullish. So I would say get ready for it, but we're not yet at the excellent buying opportunity. And I think that's all I have for today to share. So I remain bearish, so to say, looking lower for the next week. And then I think it might be time to reverse our stance and become more bullish based on seasonality, based on the wave count that we are tracking, right? Looks like we still miss a 4 and a 5. We know our price levels, below which are certain the bull market is over. But I think the short-term correction has not ended yet. If anything, it looks like we're getting close to the third of the C wave waterfall decline. We've just turned some of the technical indicators into sell signals for the first time in a month or so. So I think everything is turning towards the idea that we're having topped. Or this wave 3, wave 4, and then a wave 5 to go should be picture perfect to align with seasonality, align with the Dow Jones oil relationship, align with Elliott wave count, and some other parameters that we have been following, for example, market breadth. So we could still do that one. And of course, when we start dropping much, much lower, we know the larger B wave have topped. And even again, if we go higher, sorry, this chart, all the way to 4,500, 4,600, even 4,700, it still doesn't invalidate our bigger picture wave count. And yes, some indexes might still do a bull. Okay. I don't think so. Why? Again, I can't stress it often enough, because wave 1 and potential wave 4 have overlapped, as others have also shown. So it feels very forced to have a wave 1, 2, 3, 4, and 5. But beggars can't be choosers. We'll follow price accordingly. But remember that even in a bear market, this B wave can make a new all-time high if we have an irregular flat wave A. Then we get an irregular flat for the wave B. Okay. Because we still need eventually this larger C wave. So my bigger picture has remained unwavered. If anything, it's still nicely on track. And with that, I wish you a great weekend. Take care, trade safe, and I'll see you all next week. Bye.